You've got some spare money each month and you want to put it to work. Do you overpay your mortgage? Do you invest through a stocks and shares ISA? Or do you put more into your pension? Because the order you prioritise these can make a huge difference to your long-term wealth and how soon you can retire. Like most things in finance, there's not one simple answer that covers all bases. So instead, I'm going to rank them in these categories, and then I'm going to give you a simple decision framework to help you decide in a specific scenario which is best. I'll also touch on some intangible points that are slightly harder to measure. Before we start, this has assumed that you have no high interest debt and you also have an emergency fund between 3 to 6 months of living expenses. If you haven't got both of these things, then that should be your priority first before thinking about investing. Overpaying your mortgage, just like paying down any kind of debt, is a guaranteed return on your money. You could see it in a similar way to maybe putting cash in a bank account and getting the savings rate. That's your return. So whatever your mortgage rate is, that's your return on your money. And of course, there's no volatility there because it's fixed. With a pension and an ISA, you could put these in any order because it all depends on what you invest into. It also depends on the type of pension that you have. So for example, with a workplace pension, you'll generally have slightly less choice about what you invest into. It's then subjective to whether you think that's less volatile or more volatile, because compare that to a stocks and shares ISA where you have more choice. So in theory, you could choose less volatile investments. So in that pension, it might put you into a standard sort of typical global index fund, where in a stocks and shares ISA, you could have more money markets or bond funds, which would be less volatile. But of course, you could take that to the other spectrum as well, because you could also invest into single stocks. A SIP is slightly less different because essentially whatever you can put into an ISA, you can generally put into a SIP as well. The ISA wins this one clearly because you can access it any time. With a mortgage, that money will be tied up for a period of time. If you overpay your mortgage, you won't be able to access that capital until you come to refinance. And a lot of that will depend on the terms of your mortgage. The pension definitely has the least accessibility though, because currently you can't access it until you're 55 years old. And next year that's going to 57 years old. It is expected that for private pensions, it will follow the state pension age, just 10 years earlier. So that age could change in the future and it will likely change, but it depends what happens to the state pension. Overpaying your mortgage is definitely the easiest to implement because you don't have to put any research into investments or decide what you're going to do. You just have to set up that agreement with your bank. The pension I would put ahead of the ISA simply because it's longer term, and especially when it comes to a workplace pension, you've got less options. So in terms of that research into deciding what you're going to invest into, if you're just talking about increasing the contributions into your workplace scheme, well, you've got very little options. All you've got to decide is what percentage you're going to put in. When it comes to the ISA, it can still be long term, but you've got a lot more options. And actually, you might want to be more diversified because within that ISA, you might have different goals. I think once you've decided what you're going to invest into in the ISA, it's all fairly straightforward. These days, it's really easy to set up a monthly direct debit so you can regularly invest and have a very hands-off approach. And once it's all set up, actually the effort is really low. When it comes to returns, a lot's going to depend on the time frame that we're referring to. For this comparison, we're going to assume a slightly longer time frame, so at least 5 years. With the mortgage, we're going to get that guaranteed return on our money, so we know exactly what we're going to get. With the ISA and the pension, because they're invested, it's all going to depend on our investment returns. And if we were looking less than 5 years, it's really hard to get a reliable percentage of what we might expect. We'd just be guessing. However, the longer term we go, although there could be volatility along the way, we can be more confident that we're going to get somewhat close to the long-term average. For most investments, if we're looking over a long time frame, I like to use anywhere between 8 and 10%. That's before inflation. So because of this, we're going to put overpay the mortgage in third place because at the moment rates are around 4 to 5%. When it comes to the pension and the ISA, because you can essentially invest into the same things, it's all going to come down to their tax implications. The key difference when it comes to tax for an ISA and a pension is that with an ISA, you get taxed on the way in, where with a pension, you get taxed on the way out. But the pension wins in this case because you can take 25% of your pension tax-free when you take the money out. If it wasn't for this tax-free cash, all other things being equal, there'd be no difference in tax implications from an ISA or a pension. It doesn't matter if you get taxed on the way in or the way out. The maths still work out exactly the same. But because you get this 25%, your variable tax rate, so if you're paying 40% tax, that now goes to 30%. Likewise for 20% goes down to 15%. But where the pension really takes a step above the ISA is if you get employer contributions on top of yours. If you pay 5% into your pension, your employer has to pay in a minimum of 3%. But in many cases, they could pay in more. One of the more generous schemes I was part of, my employer paid in 10% into my pension, regardless of what I paid in. And then on top of that, they also matched my contributions. So I paid in 5%, but I'd be getting 20% going into my pension. And that's essentially just free money, which means you're never going to beat that return anywhere else. I've got to put mortgage first here because there's very little that can really change, especially if you're on a fixed rate. If you're on a variable rate, then clearly that rate can change. But in terms of overpaying, you're going to know in advance what the rules are. I've put ISA ahead of pension because I do think it's less likely that we'll see significant changes to ISAs compared to pensions. There have been some rumours in the past about potentially putting a cap on the total amount you can hold in an ISA, but I just don't think this will happen. It'll be so highly unpopular, and I don't think any government would actually follow through and implement it. One area that could potentially change is in the amount that you can invest each year. It's currently set at £20,000, and it's been that rate since 2017. And what I think they're doing here is just letting fiscal drag do its thing. So instead of that allowance increasing by inflation each year, they're freezing it. And although it was quite a generous amount when it first came in, over time, it's now been nearly 9 years. Then as people earn more money, there's going to be more people using up their whole allowance. And then eventually they'll have to put money into more taxable products. But for most people, this is not really going to affect them for a long period of time. However, with the pension, this is where a lot of policy changes could be changed. We've already touched on the age restriction going to 57 next year, and that can always increase in the future. But I don't think that element is actually as serious as what potential changes could be made to the tax implications. I don't think there's going to be changes to tax rates or anything like that. But where I think there could be changes is in the amount of tax-free cash that you can take. I think it will stay at 25%, but at the moment there's a cap of £268,275. And while for most people, they'll likely not get anywhere near that, that means you've got to have a pension pot over £1 million. But there's two things that could happen here. The first is just letting fiscal drag do its thing, just like we've seen in other areas. So over time, as people's pension pots continue to grow, suddenly that a huge amount doesn't seem quite so big. And the other more drastic change would actually be reducing that amount. So you'd still get 25%, but it would be up to that cap. And if they start reducing that down to, say, 200,000 or 150,000, that would be very controversial, but they would sell it on the fact of, oh, most people won't get anywhere near that. So this is only affecting the richest in society. But that is just speculation, and that's maybe just more cynic in me. But I think any changes to that rate would then be frozen for a number of years. So while it might be sold as just taxing the rich, over time, more and more people will be dragged into that. And actually then the tax efficiency of using a pension, because you might not get the 25%, actually your effective rate might come down to, say, 20%. It would still be better overall, but it would be less than what potentially was advertised or you thought of when you first invested into the pension. So how can we use all this to help us decide? And this is where I think it's important to ask yourself some specific questions. And this is also where some intangible points come in. The first is what other goals you have. Because when you look at returns on paper, everyone's always going to say the same thing. Over the long run, investments will always beat a mortgage. And you can't really argue with that. But the intangible part here is that peace of mind. If you can sleep better knowing that you've got no debt and you've paid off that mortgage early, then that's worth so much more than a few extra percent on your investments. You've also got to think about where you are in your career. What if you want to have a career change? What if you want to take a little bit of a break or take a risk on starting your own business? Whatever your outgoings are going to have serious implications on those decisions. If you've reduced your mortgage or paid it off, it allows you much more flexibility and freedom to be able to maybe take that break from work or go into a career change where you might have a new job that might not pay you as much. But because you've got no mortgage to pay, you can be more confident that you can fulfill your other outgoings. When it comes to peace of mind, though, it's really important to think about what your plan is after that mortgage is paid off. If you're in your 20s and your plan is to pay that mortgage off early, are you going to be in that house until you retire? For most people, I think that's unlikely. So if your goal is to pay that mortgage off, but then the idea is to get a bigger house, then you're just going to get into another mortgage, well, then it's not really peace of mind, because all you're doing is go into a bigger house and you'll still be in that mortgage. You've still got that debt. And actually, if your goal is to buy a bigger house in the future and you want to expand, then that's where return is going to be important, because if you can get more from your investments, then you can put more money into that future house. And that's going to be quicker than the rate of return you're going to get from overpaying that mortgage. But say you're a little bit later in life and your goal is to have that mortgage paid off before retirement, because when you come to draw your pension, you want to reduce your outgoings as much as possible. Well, then that's very different because you've got a clear goal. So if you're 50 and you've got 15 years left of your mortgage and you want to retire in 10 years, well, you know you've got to reduce your mortgage another 5 years so you can retire at 60. Well, you've also got to think about at that age, if you're within 10 years of retiring, you might also think about the type of investments that you hold. So you might be reducing the amount of equity you hold, and maybe you hold more bonds. And actually that's going to reduce your rate of return long term. It's going to reduce your volatility because that's what you potentially want going into retirement. But then because you've reduced your long-term returns from your investments, that gets you closer to that rate of return you're going to get on your mortgage anyway. The other thing you may want to think about is your loan to value ratio. For a lot of mortgage providers, when you get below 60% loan to value, they might actually offer you a better rate. So if you're really close to that rate, you might want to prioritize paying off a little bit more of your mortgage to get under that rate, get the preferential rate, and then maybe go back to investing into the stock market. You've also got to take into account what your current tax situation is, because that's going to change how beneficial the pension is going to be because of the tax relief that you get. So if you're a high rate taxpayer, you're getting 40% tax relief on your pension contributions. If you then go into retirement and because your outgoings are reduced, you may not want to draw as much income. So actually, you may only get taxed at 20% above your personal allowance and your tax-free cash. However, if you're currently only a basic rate taxpayer, then you only get 20% tax relief. So because you're getting less, that might push you towards either the ISA or overpaying your mortgage. And the other thing alongside that is by investing into a pension, you have the ability to reduce your gross income. And that can be important depending on how much you earn. So for example, once you earn over £100,000, you start losing your personal allowance. So that means until you earn over £125,000 to become an additional rate taxpayer, that bit in between that roughly £25,000 has a marginal tax rate of 60%. So in a lot of cases, if you're sitting at say £110,000 salary, if you put £10,000 into your pension, you've effectively got 60% tax relief going into your pension. And that's not including national insurance, depending on how you pay into the pension, and of course, student loan as well. There's other cases as well, which I'm not going to go into too much detail, things like childcare, where actually it can be really beneficial reducing your gross salary on paper. So definitely that's where the pension is worth looking into. If you wanted a more active approach, you could also look at what the stock market is currently doing. So you could look at it and think, oh, the price to earnings ratio seems quite high. Everything seems quite expensive. So actually while that's going on, I'm just going to get the guaranteed return from overpaying my mortgage. And then once there's some sort of correction in the market, say it's come down 20% for whatever reason, then that's the time when actually I'm going to switch from overpaying my mortgage to now investing into the stock market because we've had that dip. And if you get to the point where you've maxed out your ISA and you've got reasonable pension contributions, then it probably makes more sense to overpay your mortgage than simply just investing more into a general investment account. Because of the tax implications you'll have, you could be better just getting that guaranteed return, paying off the debt. The most important thing though is that you do what's right for you, and no one else can tell you what that right answer is. And just because something's better on paper doesn't always mean that's what's going to be best for you in reality in your specific circumstances. Take this as a positive that you've got this decision to make in the first place. You've got excess money to invest. You're going to get a return either way, whatever you choose. If you want more help on this, I do have a community where we can go into this in more detail. You can find out more using the top link in the description below. I hope you found that useful. Let me know your thoughts down below in the comments, and I'll catch you in the next one.